Bitcoin's above 80. It's 80 degrees outside, and we're about 80 minutes behind schedule. So we'll try to keep it tight. Thanks for bearing with us in the afternoon session. So much of what we talk about in blockchain digital assets is a bit in the abstract. And I think one nice thing about today's panel is we're going to be talking about very concrete accounting principles that affects everyone. Affects your balance sheet, your income statement, affects your LPs, affects your SEC reporting. And we have a great panel today of practitioners in the space who are doing that in really complex areas of DeFi, fund administration, asset management, and in public markets. So let's introduce the panel. I'm Skip Carlson. I'm one of the leaders of the blockchain practice at RSM. If you're not familiar with RSM, we're the 5th largest public accounting firm in the US, top 10 globally. On my team, we're just a bunch of crypto nerds that happen to work for a CPA firm. First, we have David Knox, who's the Chief Financial Officer at Hyperion DeFi Technologies, which is the preeminent hyperliquid treasury company in the space. We have Sam Gaer, who's the Chief Investment Officer at Monarq. He's already spoken at least once or twice today. He's on this panel as well. But Monarq focuses on systemic and directional bets. That's what he leads over there. We have Dinescu, who is a partner at Hilbert Capital, focusing on quantitative strategies and DeFi yield vaults as well. And we have Matthew Sheffield, Chief Investment Officer at SBET, or Sharplink, which was the first Ethereum public treasury company in the space. If I miss anything, personal details, you guys can fill that in, but for the sake of time, we'll start there. David, the first question is for you. Mm-hmm. You took over as the CFO for the first publicly listed hyperliquid DAT. Walk us through the first accounting principle or hurdle you came across and how you got comfortable signing off with it as the CFO.
Boy, that's a tough question because there's so many for how we operate. Just to add to what you highlight about us, we're the first DeFi public company building on the Hyperliquid blockchain. We have 5 independent businesses, and with that, we've earned 3 times base staking yield in the 4th quarter, 3 times ourselves. And what we do, from a business perspective, we support and monetize Hyperliquid adoption, and in our stock, we are the way retail and institutional investors can gain exposure to the full Hyperliquid ecosystem, everything that people have said here. We have 24/7 markets that are ours that we partner with, staking, validator, yield enhancement vaults, all of the above. And making that fit within the context of a US public company compliant with GAAP is a very challenging thing. I'd say it's always in the gray. You always sort of have to lean on what have others done? Okay, we're doing something different. What's a reasonable approach? But to answer it succinctly, the first thing was what to do about all these liquid staking tokens. And if you are familiar with those, it represents a right of redemption to the underlying token, in our case, Hype. And we use that so that we can deploy these tokens into multiple income streams at once. We call this the HypeD triple dip, where we literally deploy each token into 3 independent income streams at once. So liquid staking is important, but the way you value it, it's at the lower of cost or impairment. So you're sort of like marking to market a portion of your book and holding the others at this kind of low point of the period. And the way I got comfortable was I said, this is like the most conservative thing I've ever heard of. So if anyone thinks I'm wrong, they will not think that I'm aggressive.
There's a really good example of this, and I'm going to go to you, Matt. I'm going to put you on the spot a little bit, but I think this is a good education moment for where perhaps sometimes the economics in the space don't always line up with the accounting. In Q2 of 25, SBET had, this is all public information, by the way, a $103.4 million net loss, a non-cash impairment. There's also some non-cash stock in there because of your LS ETH position. This was kind of first precedent. This had happened in the time for a treasury company. It's something we looked at as a firm. Talk us through having to mark down maybe the impairment charges at the end of the year, maybe as just an opportunity to educate where perhaps because of the constraints we have around accounting doesn't always line up with the economics of the investment.
Absolutely. And I'm just going to reiterate, because our earnings are in less than a week, we are talking about Q2 of 2025 right now. we had that 9-figure impairment loss because of the rule that David was mentioning. It is always based off the lowest price that it is traded at since you acquired it. It's extremely conservative, but the important thing is we're trying to push DeFi in a public company for what is the first time in the Ethereum space, at least. And that is one of the things that the DATS is doing well. So David's company is working on this. There's a few others as well. Every time you're doing something, it's generally happening for the first time. Tax is incredibly complicated, but if you follow the letter of the law to the dot and you can prove it, you're good to go. Accounting, incredibly complicated, but you have to make sure that you are 100% in the green. There is no subject to interpretation. It's not the spirit of the rule. It is the exact rule. And until you can convince FASB that you're 100% there and creating a new robust principle, they're not going to adopt a change. And so every time we do something new, we expect that we're going to run into a corner case because these things haven't happened before. We were the first to put LSTs on a public balance sheet. We were the first to put LRTs. We were the first to use a bridge out of a qualified custodian and do that at a public company. Every time we do this, it creates a new case for accounting students everywhere. And actually, our head of DeFi teaches an accounting course as an adjunct because that's how commingled you really have to be with your accounting team and your investment team. It is one and the same because if you can't communicate to the investors what is happening, it's impossible for people to parse it out. So basically, every time we do something, we try to add min-tick amount of complication for a new deployment and then go explain it to everyone. So for people who are extremely crypto native, we've been accused of having some of the most redundant and I'd say repetitive social media because people hear us talk about the same thing for weeks on end after a new deployment. They're like, I don't really care about an LST. This is like the second thing I ever did when I had a PA. But the problem is for institutional investors, we're 46% held by large real money, pensions, endowments, active ETFs, passive ETFs. They've never heard of the liquid staking collective. They've never heard of an LST or an LRT. So you have to go out and teach them it so they can understand that that $100 million impairment is, like you said, it's a non-cash impairment, and that when you go and unstake it, you're going to realize the revenue, and when you go and unstake, you're also going to get rid of that impairment. So there's an education component, and it's really important that the other DATs, honestly, are helping us do that because it's an accounting problem, it's a PR problem, it's an IR problem, but at the end of the day, you're solving one of the best problems there is, which is how do you make safe DeFi possible, and accounting is a large part of that.
Thank you. While we're on the topic of fair value valuation, there was an important meeting that the FASB had just a few weeks ago around ASC 350, which deals with fair market value of digital assets. And like we said, there's a gap right now because wrap tokens or liquid stake tokens don't get the same treatment. David, can you kind of just educate us on what transpired in that meeting and what was introduced and hopefully we can look forward to from the FASB?
Yeah, so there's a bunch of really great working groups in the crypto space. I think some people in this room might be in those groups. And it's to help solve exactly what we're talking about here, right? Like, unfortunately, like for me personally, one of the things that I end up doing is, we report GAAP, and then I've got I think really sophisticated non-GAAP reconciliations that I'm personally very proud of, where to the investors and to the analysts, I'm like, okay, this LST impairment happened, but here's why you really shouldn't care too much about that. But of course, I should be challenged on that, and you should really see, do you agree with all this step by step? But ultimately, all that we're trying to do is give investors the right information. What does it really reflect? Is it fair? Is it complete? Does it show all the risks? So this is something that happens from time to time in the industry. We're grateful that it has. That potentially this expansion could make it easier on liquid staking tokens. There was talk about some stable coins as cash and cash equivalents. That helps us too. We are in the hyperliquid ecosystem. We have a lot of USDH, which is a hyperliquid native stablecoin. It allows for trading fee reductions. It can be used in the ecosystem. And I have to say, my cash equivalents, and my USDH. I cannot say cash and cash equivalents, including USDH. So it's honestly these conferences, these meetings to really highlight, what are the major pain points to make it easier for everyone to understand. So it's good progress, honestly.
Anna, I'm going to come to you next. You run a fund, so your stakeholders are LPs. It's not about your 10Q or share, publicly held shareholders. Maybe talk us through what your biggest accounting challenge is on, but between how you book a DeFi position relative to a fund, relative to a NASDAQ treasury company like Matt and Dave here?
Sure. One point that I'd like to make to your previous question, I think that the ASC 350 kind of figured out the playbook for how to hold crypto, not really figured out using crypto. So that's still in the definition. And I think this links a little bit to your question. And the biggest gap probably comes from answering two questions. What are you actually holding? And when are you actually accounting for it or actually recognize it? So these two questions will define probably the biggest gap. And into NAV, from a fund perspective, we use NAV-based fair value recognition accounting, which means that we trade, the position is put in, is calculated at the end of the day, then the NAV is reported, and then the investor sees it in his NAV report. Pretty much very, very simple. It could be messy, but it's flexible. When it comes to a DeFi yield, the situation is a little bit different. And it's different because we haven't yet figured it out. It doesn't really fit into any of the FAC-SE standards or revenue recognition buckets, let's call it like this. Is it an interest income? Is it a fee income? Is it capital revenue? All these questions are not actually yet answered. So that being said, when you stake or you have a wrapped Bitcoin and your tokens are generated by the protocol, you receive that in your wallet. The protocol doesn't care; they just issue them. Well, your auditor cares. That is when the biggest problem comes. And when, from a fund perspective, we have a NAV that kind of wraps everything all in, catches all, while in a NASDAQ-listed company, that doesn't apply. You don't have a NAV. So what would take for a position for an auditor to actually book that position will take probably 10 times more for a listed company, than what it will take for a fund.
Nice. Sam, you used to run tech at FINRA. When you look at these treasury companies, all these companies that are investing in digital assets, funds, when you look at their internal control environment, as their operating controls, what would make the regulators' head spin with how they're documenting today, and what would they be looking for moving forward?
Yeah, so great question. Yes, I was a CIO, Chief Information Officer at FINRA for several years, a while ago, and have a little bit of experience with that. But first, what I'd like to say is the concept of digital asset treasury vehicles is an excellent concept. And unfortunately, our industry, we don't really do ourselves a lot of favors, and in the tail end of the DAT phase last year, several companies, a lot of companies came out that actually didn't kind of cross the bar, if you will, and you've seen that in market returns. We happen to be, and I'm going to give kudos to the two gentlemen on the stage, we happen to be in the presence of two of the deals that are now still trading above their pipe price. So congratulations, that's actually a great achievement.
The bar is really high.
That being said, so when you look at what a regulator's function is, at FINRA, I mean, everything went around was called investor protection. They do everything with an eye on protecting the investor. So if you were a regulator, a couple of the things you'd probably be looking at were things like, show me who your custodian is, show me the custodial agreements. Importantly, show me the control surfaces, not just around money transfer and custody, but also around how are you managing your private keys, right? Who has access to this? Is it auditable? How often are you rotating? And so that would probably be the prime locus for me at FINRA. And then I think secondarily would also be around the equity compensation, consulting agreements, and related party transactions.
Got it.
Right? These are the things that I'd want to see controls around it. I'd want to see who signed off on it, and I'd want to make sure that it would pass the sniff test.
David, when you're building out that evidence around your pricing sources, the depth of your book test, the evidence, kind of walk us through how you do that at Hyped, and if you've come across that with your auditor.
Yeah, sure. So the hyperliquid blockchain and the services and the exchanges where it trades has changed so much in the last 9 months. So we first bought Hype in June of last year, and you can't just say, oh, this is the price. Well, why is that the price? Well, I see it here on the screen. The principal market analysis is a very important thing, and it draws on a lot of precedent on energy and commodities and stuff. So you have to say, okay, but what is the right exchange to have that price? Can you prove it? Do you show that it prevents wash trading, all this kinds of stuff? Which means, unfortunately, immediately, we cannot even use the hyperliquid decentralized exchange. The exchange that bears the token, we cannot use it. We cannot touch it because I actually can't prove that it is governed enough to prevent the trading that they're talking about. So actually, the way that we started, and we use some third-party platforms and some first-party things, is like sort of a constant analysis of within all the regulated markets out there, what's the pair? Is it against USDT or USDC? And what's the depth of the book? And what's the, all of that stuff, so that actually minute by minute, your principal market on Hype might change. It actually might switch. Now, with where we are now, with Hype trading on Coinbase and Kraken, US regulated exchanges, it might become slightly easier. But that was a hard thing to do. And full disclosure, we did hire RSM to help with that. So,
thanks for the nod there. Matt, Sharplink stakes your ETH on Linea, Consensus' layer 2 solution. Your auditor has to get comfortable with bridge security, sequencer risk, and finality. How do you walk them through that?
A really important step was that we didn't lower the standard to what the market would have allowed us to do day one, which was go into an MPC, just like everyone else has historically done for DeFi, and transfer the assets over and then go and make the representations that everything we did on the diligence front is at the same bar that our auditors would have held. Instead, we worked with one of our qualified custodial partners, Anchorage, and we said we want to be the first to do this without leaving the QC environment. Can you work with us to basically build the case for why this makes sense, or tell us why it doesn't, and work with OCC as a prereq to be able to allow the minting of an LRT directly from a qualified custodian or the use of a bridge without leaving a QC. Concurrently, you're working with your auditors to build the same fact pattern, right? Everyone wants to understand these exact same risks, and by holding that bar at the level of can we do this without leaving an OCC chartered bank, that assured us that we were going to be able to do everything at the appropriate level of standard. And it took us months to do a transaction we could have initiated in minutes had we been willing to use an MPC. And we're not necessarily saying there's anything wrong with an MPC, but what we are explicitly saying is if you use a qualified custodian, you know that there's going to be a considerable amount of scrutiny. There's already a defined level of standards, and those standards are never going to be compromised. And so if we were able to clear that test, we knew we were able to clear our own. And that's kind of what we're looking to do with the industry. We're not looking to necessarily find ways to use the tools that exist already. We're looking to partner with folks to make it worth their while to bring the highest quality tools, not just to us, but to everyone on the follow. So we did all this legwork. We were able to do it within the QC, et cetera. The day we did that, every other customer of their QC was able to go do the exact same deployment. So we did charge some first mover incentives to do all the legwork to make it worth our while. But at the end of the day, now everyone can go and do that exact same deployment within Anchorage. We're hoping to do that in many such cases and raise kind of the accounting standards along with DeFi standards concurrently.
Nice. Anna, you guys are building BTC yield vaults, HBTC, SHBTC. Obviously, we talked about wrap tokens are kind of in the crosshairs of FASB right now. What's your accounting policy today, and what would force you to reinstate that in the future?
So we're at the beginning of our journey with tokenizing our funds. Obviously, it's great to be on a panel with some of the experts here and also some of the success cases that are already there on the market. So, I mean, our policy, how it's tailored today, is that we see our wrap tokens as financial assets linked directly to our BTC holdings, which is our underlying asset. We look at the wrapping itself as more of a custodial arrangement in the sense of it's not a disposal or reacquisition of that asset. So you don't have a gain or a loss when that process happens, when the wrapping happens. And probably what would really impact here, to answer your question, is if other SEC, either FSAB, would make a complete or determine that the two are very different. So the wrapped token is a completely different asset than actually the Bitcoin itself, the underlying asset. That will mean that actually when you wrap your Bitcoins, that is actually disposal. So it will be triggering a tax event. And then obviously probably a loss and a gain if it's the case. That is not the case yet, hopefully. There are a couple of other issues that could probably be in the future. That's why we're constantly monitoring what the new developments are coming from FSAB.
All right. Sam, you recently wrote, and you posted this on LinkedIn. Everyone should follow Sam and read this. You talked about the convergence of just financial services coming on chain. He talks a lot about the concept of T+0 settlement. I think we're all in this room because we believe in the promises of blockchain technology getting us there. But if we do live in this future where we have atomic, swapped and atomic settlement, what is going to break first? Is it going to be the fair market value? Is it going to be the reconciliation? Is it going to be SOC reports from your third-party vendors? Where do you see just hurdles coming up where we are in a T+0 world?
Sure. Thank you. Sure. So also as part of my career, I was the CIO and then EVP at New York Mercantile Exchange, where we took the market from open outcry to electronic trading. And I called that the second wave of exchange evolution. We're now seeing the third wave of exchange evolution by the tokenization of real-world assets. And we're seeing this on the Hyperliquid platform. It was first. I also wrote a paper about that, shameless plug. But in reality, in my experience, what usually breaks is not the exchange or the centralized order book itself, or the liquidity providers. What usually breaks is all of the upstream and downstream providers. So think about a bank who needs to generate statements every night, send out confirmations, do accounting, flow margin on a margin call with a wire now. All of these things are built literally on software that's probably, and I'm giving it some credence here, 25 to 35 years old, right? And a lot of it's still built in COBOL or some ancient language you've probably never even heard of, and there's probably one person on the East Coast who is the consultant who maintains that. And the reason why, from a CFO's perspective, the reason why this exists is the back office systems of most banks, broker-dealers, even exchanges are unsexy. They don't produce revenue. They just work. And so these firms have not invested money in this. I saw this both at NYMEX and at FINRA when we started to do something called the Consolidated Audit Trail. Everybody know what that is? So Consolidated Audit Trail was post-flash crash of 2010. It was mandated that every firm on Wall Street was going to create an audit trail of every order that it ever placed in anything that it trades. And FINRA was going to be at the center of this. So a bank, so long story short, banks at the end of the day didn't want to invest in it, and at the same time, their systems could not handle that sort of change. Fast forward where we are today, I think they just implemented CAT just now. This was 13 or 14 years ago. Point being that there are a lot of brittle systems in TradFi right now. Crypto has the benefit of being a new technology without legacy software, without legacy process. The software and the processes, by the way, have been tested and retested, and it works. So when we're talking about what breaks, that's what's going to break.
On that thread, Matt, talk to us about key management and segregation of duties from an internal control perspective as a publicly traded company. What are the biggest risks, and what are companies out there exposed to they should be aware of?
So the nice thing about being at a digital asset treasury is that we have the closest thing outside of a sovereign to permanent capital. And so the duration of our investments is going to be on the high side. It lets us take longer term views. It also allows us to add a considerable amount of security around key management because we're not in a situation where in 30 seconds I'm going to need to go and quickly deploy. We have time to know about our deployments, timelines. We've pre-approved a lot of things, a lot of people. I'm obviously not going to comment on any specific policies, but I will say the qualified custodian part that I keep harkening back to is a part of that because in addition to having your conventional tap policies, you also have someone else who is out there verifying all of their checks that are very different than the ones we're going to have internally. So you want to have a very large quorum when you're moving very slowly because why wouldn't you? You can have the majority of a team involved with the decision making. You also want to have that third party team if you're able to move slow enough, at least on the deployment front. And then I think one thing that people don't necessarily talk about is the speed to deploy should be slower than the speed to unwind. And so in a world in which you can eventually get the qualified custodians to allow pre-signatures for whitelisted unwinds and things like that, it's actually a de-risking measure on a net-net basis because you want to be able to oversee, you want to be able to see that there was a large mint on a compromised bridge and immediately go unwind to, comment on a very recent exploit in the industry. You want to be able to quickly bring everything back to the bunker, but you want it to be very complicated and slow with a lot of people involved to be able to make the deployment. So Sharplink's trying to balance those two. Like we said, we want to be the most productive treasury on chain. That requires you to have those integrations, but you also want to be able to take all the precautionary measures and go back into a protective state on the quicker side, and that's what we're kind of partnering with folks on right now to see if we can make that happen and create a new industry standard.
Well, I have two more questions for the panel. Maybe if there's any questions from the crowd, maybe we can pass the mic around, raise your hand. So for the panel, maybe let's go down the line, maybe 30 seconds each. Is there a DeFi protocol or yield strategy you would not touch today because of the complexities around accounting?
There's a lot that we say no to, but we will say no because of risk or compliance or liquidity. We will not say no because of accounting. We are a market leader. We go head first. We trust that we'll be able to find a sound, defensible solution. If it's in the best interest of the company and the shareholders, and accounting is the only barrier, that won't stop us.
Yeah, I'm going to echo what David just said. I think that barring an auditor coming back to us and saying you absolutely can't do this, the business makes the business decisions, and we work hand in hand with our auditors to make sure that it's okay from a regulatory and a legal standpoint, but we are, except for a lack of liquidity or a recent exploit, let's just say, we wouldn't have anything off limits.
Yeah, I would agree with everything that they say. I think that the biggest problem right now from our perspective and from our CFO perspective is anything to do with the liquidity pools where you can restake those assets, so you get a liquid token that if you wrap your Bitcoins or you wrap your assets, and then that liquid token you can end up restaking it simultaneously in multiple protocols. So that will just be very hectic from accounting perspective from our side.
I would agree on the accounting front. On the audit front, I would say that has to be an open dialogue if you want to build the amount of trust with the buy side who doesn't understand all these deployments to be able to have someone like, in our case, KPMG, sign off. So yeah, if a week before quarter end, I wanted to go do our first leverage restaking vault, and we've never touched a vault before, and we've never touched leverage restaking strategy to begin with, and KPMG is like, there's zero shot that we're going to be able to make this deployment happen in time. We're going to lose the trust of the 46% institutional holders that have our stock that don't have the time to 24/7 think about these strategies, so they rely on their auditors to basically ensure that everything is being done on the up and up. So I think it's a dialogue. I agree. I think accounting should never stand in the way, but I do think audit is more of an open conversation because we're looking to push the industry forward in a collaborative way. And so I think that requires a bit of compromise there.
And to Sharplink's benefit, they were really the vanguard with that non-cash loss we talked about last year. Like, they knew that was going to be impacted, but they did it anyways because it was the best investment strategy, regardless of the gap in accounting. Was there any questions from the crowd? We'll do one more question for the panel. We'll keep it short, maybe just 15 seconds each. What's one thing every CFO or CIO in the room should do come next Monday morning from your perspective and what you've learned this far in the space?
Liquidity first, always liquidity. You can never get that wrong from a first-party perspective and be successful over the long term. Liquidity first.
Sam?
Agree, buy Hyperliquid.
Well, I'm more on the operational side, and I say accounting first and position second.
And I would say Monday morning quarterback everything. Even if you weren't in a protocol when exploit happened, you want to go back and say, could I have been in this one? Based off all the controls I have, and ensure that answer was always no. And so I'd say you have a ton of real world simulations to play around with. Go and ensure that every one of your controls is learning off of these things, but also play it as if you didn't have that foresight knowledge. Because at the end of the day, you're going to be reacting to a lot of situations live. You should get very good at using these examples to ensure your playbook's up to date.
Very good. Thank you very much.
Thank you.